Your financial advisor might legally prioritize their paycheck over your returns. This happens because advisors operate under two distinct legal standards. One standard demands they act solely in your best interest. The other standard allows them to simply recommend something suitable. This difference creates an inherent conflict of interest. The conflict intensifies when an advisor's pay is tied to the specific product sold. This structure incentivizes recommending high commission products. They often push these over lower-cost, better-performing alternatives. Many people called financial advisors are legally registered as brokers. Brokers are agents of a broker-dealer firm. They sell securities primarily for a commission. This sales relationship differs fundamentally from objective advice. Understanding the advisor's compensation model is vital. It helps identify potential bias in their recommendations. The legal distinction determines the level of protection afforded to the client. A fiduciary must act solely in the client's best interest. They must place your financial well-being above their own compensation. This duty requires recommending the lowest cost, most suitable investment option available. Fiduciaries must provide full and transparent disclosure. This includes all potential conflicts of interest and associated fees. Registered investment advisors, or RIAs, are typically held to this standard. This requirement comes from the Investment Advisors Act of 1940. The fiduciary standard is continuous throughout the entire relationship. It is not just applicable at the point of sale. Failure to adhere to this standard constitutes a serious breach of trust. This breach can result in significant legal action against the advisor. Brokers operate under the suitability standard. This is a significantly lower legal threshold than fiduciary duty. Suitability requires the investment to be appropriate for the client's profile. This profile includes age, risk tolerance, and financial goals. The suitability standard does not require the investment to be the best option. It also does not require the lowest cost option available. This allows brokers to recommend products generating higher commissions. The product only needs to meet minimum suitability criteria. For example, a broker can recommend a high-cost mutual fund. This is permissible even if a low-cost exchange-traded fund exists. The high-cost fund is suitable for the client's risk profile. This difference is the primary mechanism allowing advisors to prioritize profit over client returns. Commission-compensated advisors often recommend mutual funds with significant sales charges. These charges are commonly known as loads. A-share mutual funds typically include a front-loaded sales charge. This charge is deducted immediately from the investment principal. Additionally, 12b-1 fees are annual marketing and distribution fees. These fees are deducted directly from the fund's assets. They reduce the investor's net return over time. These specific fees compensate the advisor for selling the fund. Fee-based advisors charge both a percentage of assets under management. They also charge commissions on certain transactions. This creates a hybrid conflict of interest. True fee-only advisors charge only the assets under management fee. This structure eliminates product-based commission incentives entirely. Large brokerage firms incentivized advisors to recommend proprietary products. These are investment vehicles managed or issued by the firm itself. Proprietary products often include in-house mutual funds or annuities. They typically carry higher internal expense ratios. This is compared to comparable third-party options. Steering clients toward these products maximizes the firm's internal profit. This profit comes through increased management fees. This practice directly conflicts with the client's best interest. The client pays higher costs for equivalent or inferior performance. Advisors may receive bonuses for meeting proprietary product sales quotas. They might also receive higher pay upgrades. This incentive structure clearly violates the spirit of fiduciary care. The SEC implemented Regulation Best Interest, or Reg B, in 2020. Reg B requires brokers to mitigate conflicts of interest when recommending securities. This regulation is an enhanced suitability standard. It is explicitly not a true fiduciary standard. Reg B mandates that brokers disclose conflicts. They must act in the best interest of the customer at the time of the recommendation. However, Reg B does not require selecting the lowest cost product. It also does not require the best performing product available. The regulation focuses on disclosure and conflict mitigation. It does not focus on conflict elimination. This framework maintains the fundamental distinction. It separates the broker standard from the RIA fiduciary standard. This leaves room for higher cost suitable recommendations. Clients must demand a written affirmation from the advisor. This document should state they will act as a fiduciary at all times. This applies beyond specific transactions. Check the advisor's Form ADV Part 2B, the brochure supplement. This form details compensation, fees, and conflicts of interest. Registered investment advisors must file Form ADV. They file this with the SEC or state regulators. Use the SEC's Investment Advisor Public Disclosure Database. This tool verifies the advisor's registration status. It also allows review of their disciplinary history. If the advisor is registered as a broker-dealer representative, they are primarily operating under suitability. This is true regardless of their job title. Always confirm the legal standard governing the relationship. Breaches of fiduciary duty or suitability violations result in mandatory arbitration. This process occurs through the Financial Industry Regulatory Authority, or FINRA. Clients must file a statement of claim. This details the alleged misconduct and resulting financial harm. Successful claims require proving the recommendation was unsuitable. They must also prove the breach directly caused measurable financial damages.
Common claims involve churning, which is excessive trading for commissions. Other claims involve recommending complex products unsuitable for the client's risk profile. Arbitration awards can include recovery of investment losses. They may also cover commissions and fees paid to the advisor or firm. Demand complete transparency regarding all compensation sources. This includes 12b1 fees, revenue sharing, and referral fees. Prioritize advisors who charge only a flat fee. A percentage of assets under management is also acceptable. This structure eliminates commission incentives entirely. Always compare the expense ratios of recommended funds. Compare them against low-cost index funds or exchange-traded funds. Understanding the legal standard governing your advisor is your primary defense. Your financial success depends on aligning your advisor's interests with your wealth growth. Demand fiduciary care to protect your future.